Hey guys, welcome back to another episode of Future Wealth. Today I found this article in regards to dividends, one of my favorites so far. Not this article, but looking up and researching dividend stocks and, obviously doing my homework and finding a great buy and what the company entitles and how the dividend payback are and what percentage and if it's a good, long-term hold, right? So here's this article. I just wanted to point out a few things in regards to it. So what is a dividend? It explains that in the article, and it tries to entice people to kind of jump on the bandwagon of picking dividend stocks. If you're not an avid reader of books and Audible listening to it, where else are you going to get information, right? Besides the internet, which is here. Yahoo is very popular with the Yahoo Finance. So this article was listed there. How long ago? It was probably March 1st as of this morning of this recording. So, and then, you hit continue reading and then it brings you to another website at investors.com. It's sort of like almost like an advertisement for these companies. I don't know. I'm not saying it is, but it feels like it, right? So I went ahead and read the article, and these were the 5 dividend stocks. I believe they may be a part of the list of the. I know they're not aristocrats, right? Because I have the aristocrats here, and I don't recall seeing any of those in the aristocrats, right? So they don't have that long of a streak as far as the 25 plus years, right? Bank of Nova Scotia, I don't see that. There is no Prudential here, okay? B&G is not here as well. So Iron Mountain, I believe Iron Mountain I recall seeing. Maybe it's not in the aristocrats. Maybe it's in one of the other ones. But I know they've been around for a while. But anyway, so my point is that just because articles like these list out certain stocks that you should buy, right? It's always you should buy these stocks if you want to X or make this much or this pays well or it's going to be forecasted to be this much later on. You have to do your homework. You have to remember to not always take these articles words for it because like I said, it looked like an advertisement. It looked like it was selling like a course or something. And then it took Chevron as an example. And I did Chevron. And Chevron was not a buy because of the current price. Chevron's right here. Chevron I knew was in the aristocrats. And Chevron was not a buy. They were in the negatives. And it was priced high because, Warren Buffett had jumped on this wagon before. And then after that, people started, with the herd mentality. Okay. So my point here is I did the 5 stocks that they mentioned in this article. MPLX, Iron Mountain, B&G, Prudential Financials, and Bank of Nova Scotia. Okay? Out of the 5, I only got 2 that were a buy. And that is the Bank of Nova Scotia and B&G Food. This formula that I use is for the intrinsic value of the worth of the company at the day that I do it, based on the AAA bond yield and like I said, there's 3 blue columns that you see in front. It's those are static information. Those are the intrinsic values that was used by Benjamin Graham, and of course, even Warren Buffett has said that 2 people between him and Charlie Munger doing valuations of a stock can come out differently. So everyone has their own preference on what numbers they want to use to be more realistic, to be more optimistic, to gain a return on how much return you want back from the company and what you would buy it at, right? So that's how you get the worth of it. Some people use the current cash flow and their net profits and how much debt they have. So there's a lot of different formulas that you can use to put together this information. But this one I used, and it was also from another gentleman on YouTube, and I'll link that as well. I also did another video in regards to that. So I'm just going to drag this over a little bit just so we can see what these dividend yields are, right? So compared to the buy of the company, but the current stock price. And so far today with the MPLX, the EPS was negative 0.8. And the growth potential was at 35.4%, which was shockingly high. I'm not sure. The company hasn't been around that long. And we can look that up right now. MPLX. At least from their market, their stocks existence. So back in 2012. Okay, and you can see 2012 it started out 27.20. Sorry, let me just move this closer. And it went as high as 80 back in 2015. Wow, and then a huge dramatic loss, and it has been pretty low since then. That's 4 years out, going on to 5, and dividend yield is 11%. I don't know why they 11.5. That is 11.5. Well, it's a little lower now, so it looks like they've been cutting it. If this article has 11.5 and we see a dividend yield of 11.12, that means they've been cutting dividends. At least from what I can see. Oh, see, now here it says 11.5 on Yahoo, but it was a little different on the Google one. Okay, all right, so that's fine. And then of course you see the EPS is negative 0.8. Sorry. And of course, there's other things you can factor in, their cash flow. You can look at that balance sheet, and I mean they're in the capital expenditures, and then insurance of debt, repayment of debt. Okay, so they made a huge payment of debt. So what it is that so they definitely have the money to pay that back, plus paying the dividends. So was that a buy at the current situation? It came out as a no because of the negative EPS. Okay, I'm not digging deeper into these because these are not stocks that I'm interested in or even consider, just because they have high dividends and because it's in an article like this. Iron Mountain I know of, but at the same time I know Iron Mountain, I don't know how much people are in the office needing to shred papers and keeping things secure when no one's in the office as much. So maybe that's just the promotion for it. I don't know. But it's not a buy anyway. None of it's in the negative. The EPS is 1.19, and the growth of each year is 1.7. And the current price is $34.79, but the intrinsic value comes out to $15.39. So it's way overpriced for what it's worth as a company right now. And of course, like I said, there's always other factors to it. You can check out their cash flow and how much debt they have and whatever the netting. You can take those into consideration, and if they're a long-term hold for yourself. B&G Food did come out a buy based on its potential 5-year growth, next 5 years, and its current EPS. Its current price at $30.33, where the intrinsic value is $70.86. So there is some room. There's a huge room for potential to. It's worth what it is now, and of course you see that at 133%, and the current percentage for the yield is 6.26, which is pretty decent. These are really, obviously this list is pretty high and it goes from high to low. Prudential, I'm not I know of them. I'm not familiar. I don't use their services. But of course, it's not a buy anyway. You can see it has a negative EPS. So I would, I mean, just based on this calculation, which I use as the foundation of even investigating more into a company, I wouldn't go for it, right? So, and then the last one is the Bank of Nova Scotia. Sorry. EPS of 512. This one was pretty decent as well. And their current price is 58.29, an intrinsic value of 95.36. They are a 4.75. I have 4.9 on. I know I didn't go through each one, but I just went through the ones that I felt like needed attention to. 4.9. So it went up from this 4.75. I don't know when this article was released today, so I'm assuming it had to, the dividend raised in between that time when this article was actually put together. So a year would be paid $100. So so this is a good article for the foundation of learning about dividends, and obviously there's other materials that teaches a lot and deep dive into it and how to analyze. But it's almost like telling you this is what dividend stocks are, and here are the first 5 that you should look into because it pays high dividends. But that shouldn't be how you purchase these, because you don't know how long they've been around, and you don't know how long they can keep up with these dividends paying back. Especially now that I did my homework and I see only 2 of the 5 is a good buy, I would not even touch the other 3 unless there's, really good reason to. If this formula, if I looked at other factors, which, why it was in the negative to begin with, maybe they paid off a huge debt, right? So like, as we just saw. So, of course, there's always other things to look into. Don't always take one article and go by that and say, this article spoke about it. It was on Yahoo Finance and blah, 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 that it should be a good buy. That's not true. You know why? Because if you go to Yahoo Finance, it'll list every stock under the sun. Doesn't mean you should go buy everything, right? So it's all at your own personal discretion, your due diligence, and, what you need, the time that you put in to investigate and research certain things that you want to buy. And then you have a better foundation and better understanding of the returns that you would get, opposed to just relying on the news constantly to say blah blah is doing so and you should buy it, right? So that's just my opinion. You guys, of course, take any which way you want, but this is how I would do it, how I would consider if something is a buy or not. All right, thank you guys for watching again. Appreciate it. Bye.